Well, in today's Consumer Alert, the impact of the tariffs will be widespread, and it's not clear just yet how long we'll be feeling the impact.
Tonight, we are joined by Brian Kronberger from RBC Wealth Management Group. Brian, thank you so much for joining us.
Well, thanks for having me.
Yeah, it's been a volatile day on the stock market, and I know a lot of people are just trying to figure out what to make of all of this. Who should be worried? Should anyone be worried? I was wondering about people who are close to retirement.
Oh, this is very serious. I think it's fair to say the reality is that the era of globalization is over with. I do not think these tariffs are going away anytime in the near future. There will be basically a tax on imports coming into this country, and then there will be some reciprocal taxes, vice versa, to other countries. And I would say that the economy is likely to slow, and if the economy is likely to slow, then that's going to have an impact on availability to work at different places, wage growth, et cetera. So I think the market's reaction today was probably justified. The Dow's down almost 5, the S&P 500 down 8, the Nasdaq down a little bit more than that, and there's definitely some fear here on Wall Street.
Brian, tell me about the everyday concerns as I'm walking into the grocery store to buy a car, to get clothes. What will I feel once these start really rolling out?
Well, I think you'll feel some one-time pain in terms of price increases. That's not likely to continue because if the economy is slowing down, then you'll have that one-time bump in inflation. But I would say it's still sticker shock. I mean, recession odds are higher. And at the same time, a lot of the forecasts for year-over-year inflation will be around 4% at the end of the year. That's higher than where we are now. Nothing like we've seen the past couple of years. I think from a consumer goods standpoint, you will see higher prices over the next 60 to 90 days, and they're likely to be sticky and not to be lower because of those input costs. Remember, the U.S. is the great growth engine of the world, but at the same time, we need those supplies. Those supplies right now are not in the United States, and they're not manufactured here, and so that's why the costs will be higher.
Sure.
When you talk about supplies, I know we've been talking a lot about car buying. I'm wondering about people who are looking to buy a house, which typically in the spring is a pretty popular time to do that. What are the concerns for those people? What do they have ahead?
Well, one of the positive news, and I think the strategy of the Trump team, is to bend the yield curve, the long end of the yield curve lower, and that has happened. The 10-year Treasury's at 4, the 30-year Treasury's below 4.5. So housing affordability is going to be stronger. The problem is that if you feel uncomfortable about your portfolio that's gone lower, and you've got a great mortgage rate, let's say in the 2s or 3s because you bought the house a long time ago, you're less likely to part with that house. So housing availability will be crucial coming up. But overall, I think slowdown in the economy, less opportunities for workers, not only in this country, but around the world. I think the Federal Reserve could save the day later in the year, but they'll take a wait-and-see approach to make sure that inflation is not spiraling higher like it did several years ago when they had egg on their face.
Sure. Coming into work today, I heard an interview Volkswagen. They're going to put on the sticker the tax that they're going to be charged so that the consumer can see it. Will we see more of that, or is it sort of like, see no evil and you don't know what you're dealing with? You'll just go ahead and buy.
Well, I think the scary part of this is that nationalism, not unlike what I've read in the 1930s, and protectionism is probably backed by America. You'll see all kinds of marketing anecdotes. U.S. manufactured cars probably skyrocket because those imported cars are going to be much more expensive. So in the short run, it'll be great for inventory that are on American lots right now in the automobile industry. But once those cars are kind of washed out, if we can't keep up with the demand, I would imagine that consumers are going to keep their old cars, and they're already pretty old. The average car is over 10 years old. That's like a 14-year high, and I think that will continue. And probably one of the great areas to consider investing is those auto parts cars, because if we're not buying new cars because they're expensive, I think those auto parts dealers, those retailers probably are going to be pretty strong.
Sure.
I know most of you economic experts always talk about, people when they're looking at their 401ks to just, let it ride and keep watching it. What advice can you give to people as they're looking at what's going on with their investments and their retirement?
Yeah, there'll be a lot of people tonight and over the weekend looking at their investment accounts. I mean, generally speaking, if you're diversifying, you felt comfortable with the risk. Not that anybody likes to see their account statements go lower. I would stay the course. However, if you've been a momentum investor and you've been investing a lot of money in the Magnificent Seven, I would be careful here because those valuations are still high even after the bloodbath today. And I would look to be diversified. Bonds, make sure you have some international investments, and dividend-producing stocks, which have been unloved for the past 5 years, are doing really well on a relative basis. I think it's time to make sure that you have enough defensive investments, even if you're an aggressive investor. That'll allow you to sleep at night and look for opportunities as opposed to really riding the giant waves that we're seeing, especially on the technology front.